Innovation at the Solicitors Regulation Authority, and I'm joined by my colleague Chris Hansford, who's the Director of Regulatory Policy. We're really glad we've got a number of people signed up. Before we start with Chris's presentation, I've got a few ground rules. We've had a number of pre-submitted questions, which I'm sure we'll be able to get round to, but equally, many of you might want to contribute questions for answer this morning. And to do so, you just need to use the link that's below the video and submit questions that will come through to me, and I'll be sort of question mistress for the morning. The title of this seminar is about post 6-year runoff cover and what we do next with the Solicitors Indemnity Fund. We launched this consultation in November last month, and it's running for 12 weeks. This webinar is one of the stakeholder engagements events we've been doing. We've done a number and there are more to come. But just to say, if you've got any other comments or you want to make contact after today, you can also get in touch with us separately and we'll get back to you quickly. And we obviously are urging everybody to contribute formally a response to the consultation. And as I say, you've got 12 weeks. We're probably down now to about 8 for you to do that, but we'll give all the details at the end. Just to make sure that we don't overspill our time, I'm going to move straight to Chris and ask him to start the presentation. And then, as I say, we should have at least a good 30 minutes or more for questions and just submit them as we go through the link. Thank you. Over to you, Chris.
Great, thank you. I think we've got the first slide up. So this is about the future of post 6-year runoff cover and the Solicitors Indemnity Fund, which I appreciate is a very important issue for lots of people, and it's not a simple or straightforward one. And discussions about the long-term future of the Solicitors Indemnity Fund have been going on for several years. So this consultation really sets us up to have a final long-term position once and for all with clear next steps. So as Tracy said, we have issued the consultation. That is open until the 15th of February. And within that, we've put, all of our, totally transparent with all of our evidence, all of our analysis and current thinking. So I'm going to start by just giving a little bit of background about our existing professional indemnity insurance arrangements. People who use a solicitor's firm can claim against a firm's professional indemnity insurance for losses incurred when things go wrong because of a solicitor's negligence. And we set the minimum terms and conditions for the PII that regulated firms must buy on the open market, and which the participating insurers must provide. So this includes a requirement for firms closing without a successor practice to purchase cover for negligence claims made within 6 years of the firm closing. So that's what we call runoff cover. And the firm's last insurer has to provide this level of cover, and that's even if the firm does not pay the premium. So guaranteed protections for 6 years after the firm closes. And this is among the most comprehensive protection in any jurisdiction in the world and across any professional services sector. Historical claims data shows that around 90% of all runoff claims are made within the 6 years covered by the minimum terms and conditions. And 6 years is, of course, the usual limitation period within which professional negligence claims can be made in the courts. So currently there is also an additional cover provided for claims made later than 6 years, so more than 6 years after a firm closes. That's known as post 6-year runoff cover, and that's what's provided through at the moment through the Solicitors Indemnity Fund, and that's what the consultation is about. So if we move on to the next slide, I'll just provide a little bit of history about the Solicitors Indemnity Fund. So the Law Society established the Solicitors Indemnity Fund, or SIF as it's shortened to, which is a mutual indemnity insurance fund in 1987 to provide the professional indemnity cover for all law firms in England and Wales, and that was funded through mandatory contributions from the profession. Then in 2000, following a vote of its members, the Law Society decided to put the Solicitors Indemnity Fund into runoff and move to an open market insurance model, and that's what's governed by our minimum terms and conditions. So SIF initially remained liable for and will remain liable for claims made while it was open, and also for claims made against firms that closed before the 31st of August 2000 without a successor practice. And that will remain to be covered, whether through SIF or an alternative arrangement. Those liabilities will be covered on an ongoing basis. Then in 2004, the Law Society also decided to use SIF surplus, so money that had been built up within the fund, to pay for and fund post 6-year runoff cover for firms that closed without a successor practice. And initially, that was set up to run until 2017. We took on the arrangements for the Solicitors Indemnity Fund came under us in 2006, when we were established as the regulatory body for the solicitors profession, along with all other regulatory arrangements. And since that time, we've extended post 6-year runoff cover provided through the Solicitors Indemnity Fund 3 times. Most recently, our board agreed to an extension until the 30th of September 2022 to allow for this consultation on the scheme's future, to provide certainty and a long-term position. So that's what the consultation is about. Okay, so some of the key questions to consider on the next slide. So first of all, the question about whether our regulatory arrangements should include post 6-year runoff cover to protect consumers, and if so, what should that look like and who should pay for it? And the context here is that Solicitors Indemnity Fund and its post 6-year runoff cover are still covered from residual funds, so nobody has paid into SIF for a very long time. There's no money taken from the practicing certificate fees to fund SIF. It is purely funded through residual funds. SIF Limited, who operate the Solicitors Indemnity Fund, it's an independent organisation, has told us that any further extension is not prudent without additional funding. So a levy of some kind will be needed to continue with this protection. It can't carry on running off residual funds forever in the way that it does at the moment. Other things to note is that in its current form, the Solicitors Indemnity Fund is expensive to operate, with a high value of fixed costs compared to the number of claims it processes each year. So that's the first question that we're looking at, and within the consultation we also set out what different options might be for providing post 6-year runoff cover, and we're inviting views during the consultation on the impacts of different options on consumers and solicitors. So if we move on to the next slide, about the position we've put in the consultation paper and the options that we've developed. So, as I said, we've set out clearly all of our evidence, analysis, and our current thinking. So we've put in place a decision-making framework for developing those options, and these unsurprisingly centres around the provisions in the Legal Services Act 2007, which is the main act that sets out our regulatory purpose and our purpose as a public interest regulator. And our role is to balance all of the regulatory objectives and the relevant principles set out in that act, including the better regulation principles to be proportionate, targeted, transparent, consistent, and accountable. And we're seeking within that framework to deliver a regulatory system that delivers the best possible outcomes in this context with an appropriate level of consumer protection. Regulation cannot guarantee that there is no risk to consumers. And we are constrained by law from acting outside our public interest regulatory remit, or for the purpose of supporting or protecting members of the profession. That's a representative duty for the Law Society, not a regulatory function. So any such benefits from our regulation are incidental. And that's really important context given the purpose that post 6 year runoff cover serves at the moment. There's two main purposes. It does provide continuity of client financial protection, which is principally a regulatory function. It also provides security for retired solicitors. It's sometimes referred to as the sleep easy factor, which we consider is more appropriately a matter for the representative body rather than being a regulatory function. So we set out that framework clearly in the consultation, and you can see our analysis against it there. Looking at data, we have commissioned Willis Towers Watson, who are the leading actuaries in this area, and insurance experts who are familiar with SIF. So we got them to analyse claim patterns and assess impacts on consumers and solicitors firms of the terminating post 6 year runoff cover and different options for continuing with it and the viability of those options. And that independent report has been published alongside the consultation. So all of that data is there for you to see. And what it shows is that to carry on as it is, the Solicitors Indemnity Fund would need up to a maximum of 2.4 million a year to keep going. But the forecasts are that there are around 31 claims a year that receive any kind of payout. That's on a normalized basis going forward, and the average payout is around just under £35,000, and that includes defence costs. So that's not just the money that goes to consumers who have lost out. So any ongoing costs would need to be paid for by the profession. And obviously, as with all costs, then at least some of that is likely to be passed on to consumers. So the questions that we are looking at and asking is whether that provision remains proportionate and efficient, given the number of claims that are coming through. We've also looked at what other professional service regulators do, and we've included some details of that within our consultation and the regulatory impact assessment. And we continue to talk to other regulators, and the headline from that is we are an outlier with the level of protection that we have past 6 years. So there are very few bodies that will require and have regulatory arrangements to cover beyond 6 years after a firm closes. We've also been doing loads of stakeholder engagement, and it's great that so many people are here listening to this today. And part of that, we have a virtual reference group, which includes, as 29 delegates, includes representatives from the Legal Services Consumer Panel, the Law Society, Local Law Society, groups representing different segments of the profession, and also a range of insurance interests. So we've been talking to them. We did some polling with them about different options, and some information about that is included within the consultation as well. And as I said, we have published all of the information and all of the analysis to date. So where does that take us in terms of the options that we set out? So on the next slide, well, we have considered carrying on with post 6 year runoff cover through the Solicitors Indemnity Fund as is. The issues, or one of the issues with that, as I've said, is that in its current form it is expensive, and it would not be prudent to continue without new funding arrangements. We've also considered whether there is some sort of alternative indemnity fund of a different kind could be developed as a cheaper option, and I think that there probably is cheaper options there, but it will remain an expensive operation because of the nature of this operation with long tail claims and the cost of doing that with the establishing liability, limitation periods, locating records, etc. And SIF will inform us that it's not unusual for claims to remain open for 4 or 5 years. So this is always going to be an expensive operation. We've also considered what options might be there on the insurance market. So could there be some sort of master policy? And we're really keen to hear views and get information about that, particularly from insurers. the initial indication that we've had, and in fact we had a meeting with a virtual reference group yesterday with insurers who confirmed this, and due to the small number and value of claims and the potential volatility that creates and the expense of dealing with long tail claims, it's unlikely that there will be a lot of interest and with cheap options for delivering a master policy. So the other option is whether solicitors could get insurance on the open market, and the information that we have from insurers on that is that some might be able to, particularly where they have an existing relationship with the insurer and they have a reasonable risk profile. But at the moment, there isn't a universal option for post 6 year runoff cover, and there's no firm details of any policy out there at the moment. And we also consider in the consultation whether there could be greater targeting of cover and whether that might be an option to have a cheaper, more proportionate operation. And there is questions around, if there is post 6 year runoff cover, who should it be provided for? Should that be for the whole profession and all of its clients, or just certain segments? And then who should pay for it? So it's very clear from the data that the claims are clustered in certain segments. So over 85% of claims are centered around conveyancing, wills, trusts, and probate work, and claims mainly relate to smaller firms and sole practitioners. So given all of that, we have set out our preferred option for consultation, so our initial thinking, and that is that having regulatory arrangements for requiring ongoing post 6 year runoff cover as a condition of practice for solicitors and firms is unlikely to be a proportionate arrangement on consumer protection grounds, given that there are likely to be only 30 odd claims each year where payments are made, and the cost of those claims with the inherently high costs of operating a long tail claims regime. So under that option, there would be guaranteed protection, which would remain for open firms and claims made within 6 years of a firm closing, as provided by minimum terms and conditions, but no guaranteed protection beyond that, which would mean that the normal recourse for people would be to go through the courts, as happens in different sections of the economy, and take action against the negligent person or firm. So it's not a guarantee, and it's obviously it has cost attached to it. There are no win, no fee options available and professional support option for people. And we'll consider, under that option, we would consider what information could be given to people at different times to help them understand the options open to them. We're also considering and would really welcome views on whether there's anything else we could do to help mitigate the risk for clients if post 6 year runoff cover isn't there, potentially working with the Law Society. So is there some more support that we can give to firms thinking about closing, about how they might attract successor practice? And we're considering whether reviewing our successor practice rules might help. And also, as I mentioned, thinking about information that we might be able to give to clients at the time a firm closes, so they understand the options available. So that's kind of our thinking as the regulatory organisation on consumer protection grounds. We really appreciate this is as well as consumer protection. This is a really important issue to lots of solicitors, and we have offered to support and help work through options with the Law Society about anything that they may wish to do to help as a member benefit for solicitors to help provide that sleep easy factor. It's obviously a very different equation if you're thinking in terms of services offered to solicitors for their benefit as compared to what's a proportionate consumer protection regime that should be made a condition of practicing and being authorised to practice as a law firm and solicitor. Okay, so I'll stop there with the presentation, and then just one last slide which sets out the sort of the timings, which I've kind of covered a little bit. So the consultation is open 12 weeks. It closes on the 15th of February. and then we'll be looking to make decisions following the consultation, having considered all of the responses in spring next year, and we'll consider whether a further consultation is needed at that point around any rule changes that are required. And as I mentioned at the beginning, under the current rules, then the post 6 year runoff cover provided by Solicitors Indemnity Fund is scheduled to end in September 2022. So that's our kind of end date that we're working to. So we're doing lots of engagement going forward, and it'd be great to hear your views and questions now. But as Tracy said at the beginning, then please do get in touch during the consultation period, and really would be great if you could put in formal responses as well.
Oh, thank you so much, Chris. We've already got questions coming in, and as I said, we had some pre-submitted ones. So
Yeah.
I think we'll launch straight in.
Sure.
A couple of people on the call have made this point about, the insurers and whether there is. So there's a question from Richard which sums it up nicely, which is, could you tell us a little bit more about how you've engaged with insurers, what options have been explored for something post 6 year policies? You touched on it. There doesn't seem to be a massive appetite. Do you want to explain a little bit what they've told us about why there isn't and what their options that they think might work could be?
Yeah, so we have talked to a number of insurers and representatives from insurance industry, and they're involved in our virtual reference group. So we've had 3 meetings of that so far, the last one being yesterday. And the issue really is that because of the nature of the claims, them being very old claims, and the difficulties that causes around things like establishing liability and just finding records and having evidence, etc. And the small number of claims that there are, it's a tiny market. So we said there's 31 claims a year. It's not the most attractive market for insurers to get involved with, and it does carry risk. And given the small number, if you have 1 or 2 very large claims, then that can have a huge impact on the profile, and that's hard to predict. So what insurers have told us is that although there's nothing available at the moment, obviously because SIF covers this, that the most likely position that we're hearing is that there may be cover available for firms where the insurer has a relationship with them already. So if it's open, if it's still within the 6 year runoff period and the firm paid their premium and they've got a reasonable risk profile, then it may be that insurance comes through for those. For other firms that don't have that, insurers are less likely to be interested in offering that insurance. So that's the current position as we understand it. We've obviously put out all of the data and the claims patterns with the consultation, which went out in November. So I'm sure the insurers will be looking at that, and it will give them a much more informed picture of the market. So we'll see what develops, and we'll carry on engaging with them during the consultation period.
Yeah, thanks, Chris. Quite a few of the pre-submitted questions touched on similar things, so I won't repeat some of those. But I've got another one here, which again I think probably goes to the heart of what lots of people want to know is why is it that the management and running costs of SIF currently are so high? Could there be something to do that would make the money go further? Why are PS claims so expensive to handle? What's so special about them, and what needs to be done? So if you could touch on that one, that would be great.
Sure. I mean, so SIFL, Solicitors Indemnity Fund Limited, who are the independent organisation that runs SIF, I mean, they obviously set their model, and because they are a small organisation with a small number of claims, and this is all that they do, then they outsource quite a lot of their claims handling work. So it is an expensive model. Could there be cheaper models? Yes, I'm sure that there could be. SIFL also takes a very conservative approach or prudent approach to the capital reserves, so the capital funds that they maintain. But this is always going to be expensive, and part of the reasons for that is it takes a long time to establish whether a claim is valid or not and the amount that might be paid out. So reserving levels have to be high at the outset, and for the reasons that I've mentioned, it's a long process. It's a long and resource intensive process to deal with these claims. So it's always going to be expensive. I'm sure there could be cheaper models, and we cover that in the consultation.
That's helpful, Chris. And it leads into another question that we've had live, which is one from David, which is saying, how much exploration has there been about a voluntary scheme, a scheme where people could choose to pay into it and those that paid in benefited? And could that be run by a sort of voluntary organisation, something new? Or is that the sort of member benefit thing that the Law Society could be running? Is that what you were touching on in the presentation?
Yeah. So exactly right. So our remit and our regulatory position is around what's a proportionate regulatory arrangement. So that's something that is required for solicitors and law firms as a condition of them practicing. Very different consideration about member benefits, as you say. That's not our role to do, and in fact, that's beyond our remit. So we can't develop those sort of member benefit options. We have been very clear in the consultation paper that we are on hand to talk to the Law Society and support them in any options that they might be considering. And if we decide that there should not be post-6 runoff cover and that SIF should close as a result and just cover its past liabilities, then any residual funds within SIF we would consider whether there's another indemnity purpose, but if not, then that money would go to the Law Society to use for the benefit of the profession.
So that's interesting. So the residual funds, so to speak, if someone can come up with a way of running some different scheme, that would be acceptable if the oversight regulator, I imagine the LSB, were to agree to that.
Yes, exactly right, and there would probably be some money to start that off coming from SIF residual funds, and the key thing is that the Law Society or representative body, they're limited and restricted from delivering any or putting in place any regulatory arrangements around indemnity. So again, I just emphasise that are the conditions that must be met in order to practice. But they can do voluntary. There's voluntary options that could be done, and in fact, we've spoken to lots of firms, including firms that city firms, for example, that might not benefit from this because it's mainly around those areas of law conveyancing, wills, trusts, and probate. So many small firms that may be willing to contribute to a voluntary scheme, but slightly different positions potentially if that is made a condition of their practice and they're mandated to pay that. So yeah, there are options there to be explored, I think.
So I think from the questions that are coming in live in the pre-submitted, this idea of a voluntary scheme and only those who contribute are the ones who benefit, but it's open and run by someone like the Law Society seems to be something there's quite a lot of support for. I've got another question which was pre-submitted. It's quite an open one. It's what is the situation with regards to firms operating as limited liability partnerships? So is there some clarification there, or is it no change?
Well, there's no change there. I mean, that's the sort of the legal position with business models that I think that limited liability partnerships have been allowed and around since the early 2000s, I think. So yeah, if a firm closes without, if limited liability partnership closes without a successor practice and the company is dissolved, as it happens, then it will no longer exist. So as in any other part of the economy standard position, a claim can't be brought against it. So yeah, no change there, and the sort of the standard position across the economy.
It's good. It's good. I think from some of the pre-submitted questions, there's a lot of clarifications that probably the consultation is helping with as well. Things that people just never asked about, assumed an answer. So that's good.
Yeah.
I've got another one, which is again around what happens. So if SIFCON just continues, how much longer? Are there issues around how much it could be run? I suppose it's back to the first question about running costs and so on. But there isn't any way of doing it the same at the same cost. If we carry on with SIF, it's at a fairly high running cost, and nothing else is short of a new scheme. Is that right? Or
yeah, so as I say, SIF at the moment is run by SIFL, independent company. So that there potentially could be other options, but it will always be expensive. And at some point, so SIF will tell us that it's you can't extend. It wouldn't be prudent to extend any further without getting more money in. So at the moment, they just have the residual funds, and they have to have high levels of capital reserves, because obviously with no funds coming in, then the risk of high value claims coming in, that needs to be covered. So it can't carry on. It can't carry on much longer as is without further contributions from the profession in some way.
Thanks, Chris. A number of people got different questions around that point. I've got another one that's just come in live. We haven't got a name, but it's the question is, if there is no post 6-year runoff cover and a solicitor cannot pay for any historical claim, does that mean his former employer is liable?
Partners and individuals within firms can be liable. They can be taken through the courts. There is liability there for individuals and the partners of and managers of firms.
Yeah, a number of people have asked the question in different ways, just coming again from the floor. You know, how do I limit my liability? But what you're saying is, this is how liable, how likely is a claim to crystallise? This is this balance about costs and proportionality and benefits, isn't it? But
exactly right. Yeah, and there's lots of people out there that will advise firms on how to structure them, how to structure themselves.
Yeah. Okay. A number of other people are talking about a voluntary scheme, and we've had a particular question about how long it might take to establish one. And you made very clear that the current extension runs out in September 2022. Have we got any advice about how long it might be to get a voluntary scheme set up? I'm supposing if it's the Law Society or somebody and they've got good lists of membership and so on, practically it could be done relatively quickly.
Yeah, I would assume so. There's organisations that can do this, but as I say, this is an option for the Law Society. So I think the question should really go to them, and so we've offered our support in that. But I imagine it can be done quickly, but that's not our role to be establishing. So it's one to speak to the Law Society about.
Okay. I'm just getting a reminder out to everybody. We've got about 10 minutes left of our scheduled time. I haven't seen a massive more questions coming, but if you have got more to submit now, do, and then I'll finish on the pre-submitted ones. But I can see that David, I'm assuming it might be the same David, is asking a follow-up, whether it is simply a case of asking all solicitors to pay a very small contribution. You know, if there are a number of solicitors, 2.5 million, everybody's share is not a massive amount of money. How would that be done again through the Law Society?
So if it's a voluntary scheme, yes. So we do set out, and Willis Towers Watson have put some figures in there that they forecast that the cost would be around £16 a solicitor on a flat fee basis, or around £240 a firm. What we explore is whether, on top of all of the other regulatory requirements and costs in professional indemnity insurance, including the 6 years runoff that we do mandate, whether an additional amount on top of that is proportionate. So that's our consideration for any sort of voluntary scheme. Then it will depend on the terms that are agreed. But that's the figure that WTW have put forward.
I hope people on the call have had a chance to look at the WTW report. I mean, it's very detailed, but we did want to be absolutely transparent and open with all the data, and having someone like that independently assess it for us, we thought was quite important to share. I've got a couple more questions. Michael has asked, how long notice period for any change would we get, i.e. time to find alternatives before new liabilities were to arise?
Yeah, so there's the cover as is for any notifications made before the end of September 2022 will be covered on an ongoing basis, and consultation closes on the 15th of February, so we will be looking at spring to give our board will make a decision on its preferred way forward, having considered all the consultation responses.
Okay, thank you, Chris. I've got one more also from David, but pre-submitted, and it's about our firm closed in 1999. What is our position now, and if SIF closes?
Yeah, so SIF, it's historical liabilities, and so what will continue to be covered is cover for firms that closed before 2000 without a successor practice. So 1999, you'll be covered.
Okay, brilliant. I've got another question that's just come in. It's from Neil. He's saying, can you just clarify, firms that close before when will remain covered for historic claims? And I think you've just done this in response to the question to David. And is that even if SIF funds are exhausted? So there's just a slight clarification about that. So, you know, if the money runs out, it runs out. What happens if would be within period, but there is no money?
So, I mean, if it's an ongoing consideration, there has to be the money in there, and that's one of the reasons why there's a high level of reserves within the Indemnity Fund. So yes, firms that closed before 2000 and any claims that are notified before the end of September 2022 will be covered, and the existing SIF funds will be used to cover those claims.
So this is back to the point about why the costs of running SIF are so high. It's very prudent. They're putting aside all sorts of reserves and so on. They're paying for good advice about where that's invested and so on. And this is the principle, is to make sure that anything that's within scope is paid. Exactly so right. I hope that answers your question, Neil. I haven't got any more questions that have come up, but just a reminder now, we are down to the last 5 minutes, so do submit if you've got any more. I've got one more, which I'm not sure I quite I know what the question is getting at. This is a question that was submitted by Andrew, and it's, will the insurers insist on runoff cover even if it is not a regulatory requirement? So I'm not quite sure what that means. Is that something that's going to be an ongoing consideration, or I may be misunderstanding? What's your interpretation of that one, Chris?
So, I mean, we set the minimum terms and conditions around what insurance must cover, and then participating insurers must comply with those minimum terms and conditions. So that requires that there be runoff cover provided for 6 years after a firm closes. And as I mentioned earlier, that is whether or not the premium is paid. That's the guaranteed cover. Anything beyond that would be without post-6 runoff cover through the Solicitors Indemnity Fund or one of the other options. That would be a voluntary option. So it would be for firms and individuals to agree with insurers, you know, if insurers will cover them about the terms of that. So I don't think insurers can't require that. They may provide that.
Okay, I've got a couple more questions that have just come in. There are questions around the difference and distinction between partners and employees, and where the various liabilities go. I think you've covered it in your answers to both questions, but just to clarify that it is the situation now, depending on your structure.
Yeah, exactly. So it can be employees as well. Perhaps, given the questions today, I think maybe we will perhaps put something on our website that just sets out exactly, you know, who's covered and who may be liable to claims. It sounds like there's quite a few questions coming in about that.
Yeah, I think that's helpful. I've got one more as well, which is really around the position of consumers. So again, we touch on it in quite a lot of detail in the consultation document, don't we? Because our responsibilities as the regulator is to be proportionate about the cost versus the benefit for consumers. But again, that would be dealt with. Someone's just checking on a voluntary scheme. It wouldn't just be the sleep easy factor. And I think that's the point, isn't it? You're sleeping easy because your consumer or the claims against you would be covered.
Yeah, exactly right. So there's the number of claims that actually come in are quite small. Obviously, very important to those people who do have something go wrong. But the sleep easy factor for solicitors is a totally different equation, because you don't know whether there's going to be a claim against you or not potentially. So that's a different equation. But yes, most likely through any arrangements there could be a consumer protection element to that. I guess other alternatives would be you could have something that covers the claims. You could have hardship type funds for solicitors, so that they have the money to pay for any claims that come through, provided through a voluntary scheme. So different ways that it could be cut, but it would benefit those small number of consumers that do make a claim, as well as solicitors, most likely.
Yeah, a number of people have commented that, you know, seeing the figures, I think people have got a better understanding of what the sort of ongoing costs of SIFL are, and it may be one of those things that, you know, with hindsight you could have done differently, but given the prudential arrangements that they're following, it's sort of understandable. A number of other people just were talking about, again, this alternative fund and voluntary or not, and I think that's going to be the nub of the responses, isn't it, about what a replacement voluntary scheme might look like, and therefore it's the people who pay in who benefit, and if that looks affordable, or the number of people would be interested, then that looks possible, I think. We've got 4 minutes left, so it's my final call for any other questions. If not, I wonder if there are any observations, last 2 minutes, Chris, you want to make, and I'll just sum up at the end about how people contact us going forward.
No, I mean, no, I've got no observation. I just to highlight, I think that the consultation paper is relatively short. Hopefully it's pretty clear, and there's a load of evidence and analysis there. So all the information you should need is in that consultation. So I just urge you to have a look at it, put your responses in, get in touch. And yeah, if you have any questions that come to you after this, then yeah, just please get in touch with us, and we'll answer those.
Thanks so much, Chris. Thank you. Well, thanks everybody for the questions that you submitted live this morning, and anyone who submitted them in advance. Our aim in this is to get as broadest a stakeholder opinion as we can, and look at what the alternatives are going to be going forward, and what people's views are. So I can't tell you how important it is that you do get in contact with us. Please submit a response to the consultation. We will analyse those, and hopefully come out with a sort of statement around the late spring. And then, as Chris has already said, September 2022 is the sort of the date that current arrangements expire, so to speak. So we want really to be sure that we've got broader feedback as we can. You'd be reminded 15th of February is the date to get your consultation responses into us. If anybody wants to follow up with any questions, you can get in touch with us via email or so on, but don't hesitate. Any other points of clarification? I'm conscious that today we mentioned a bit more about the Law Society and any sort of voluntary schemes that they might put in. So that's obviously another route. You can check on any points with them. We are very happy to do further events and so on, and webinars if that's helpful to people. So do give us your feedback. Again, there's a link here. Let us know how you found today. Did we cover the right sort of balance of questions? Do you think it's worth us doing more of this kind of webinar? And would you appreciate an update about results of the consultation, that kind of thing? Just let us know. But for now, thank you very much for everybody who took part. Thanks for all the very good questions. I think there's quite a few common patterns about, you know, what would the next thing look like? How would you do it on a voluntary basis, and so on. But I think people seem to be finding the detail in the consultation helpful for understanding what residual funds there might be, and so on. So one last thank you, and really hope you enjoyed the rest of your day. Thanks for joining us this morning. Oh yeah, there's also I've just been reminded a feedback link again about the format and how you found today. So do use that as well. Thank you very much. Goodbye.
Thank you.